Hello Maverick Traders, this is Imre and welcome to this next video in my ongoing series of how to trade corrective patterns. In today's video we'll be covering what is quite possibly my favorite pattern to trade, which is the triangle. Alright, so just a quick refresher on triangles. They occur in just prior to the final actionary sequence in a trending movement. Alright, so triangles cannot take shape in the wave 2 position of an impulsive wave count. They can only take place in wave 4. Why? Because wave 5 is the final actionary sequence. In a corrective structure, a triangle can take place in the wave B position. Why? Because wave C is the final actionary sequence. Okay, so in terms of entry and stop loss techniques, there is one entry technique that I like to use to trade triangle variations, including the running, contracting, and barrier permutations. I strongly advise against trading expanding triangles. The reason for this is that A, expanding triangles are exceptionally rare, and B, they're very difficult to identify in real time. The best way to trade an expanding triangle is to wait for an impulsive wave breaking out of the triangle to conclude, and then trade its corresponding corrective pattern. The entry guideline for triangles is very simple. It's always going to be a key level break, and it's to take a position upon a break of wave D of the triangle. The stop loss guideline for triangles is also very straightforward. It's always best to place your protective stop just beyond the extreme of wave E of the triangle. So what does that look like? Well, let's take a look at this example of a triangle in the Aussie yen currency pair on the daily chart. So here, we've got the 5 points of the triangle, and you can see that I've drawn out the trend lines for the triangle. We have the AC trend line and the BD trend line. Okay, so here is our impulsive wave, which in this case is a wave A. We have sideways price action for the triangle, and then we have our 5 points of contact, A, B, C, D, and E. All right. One of the reasons I love trading triangles is because how simple this pattern really is. So I have an exact key level to look out for, 77.10. All right. Once we break 77.10, I'm in the trade. Where's my stop loss? Just beyond the extreme of wave E. This is what gives us excellent risk-reward ratios. All right, when it comes to triangles, is utilizing this guidance. All right, and I'm telling you, it works really, really well. Okay, so here we have a triangle in Apple, and I'm going to be looking at some cryptocurrencies, some stock charts. It doesn't matter what the market is; the patterns are always going to be the same. So you can see here in Apple, the wave D break came in at 137.07, and then we had a stop loss just below the wave E extreme. The other thing I love about triangles is that they tend to resolve fairly swiftly. We're looking for an explosive thrust out of that triangle, right? So if a triangle, once you're in a trade, and the triangle hasn't really taken off all that quickly, one of the reasons for that could be that you've either mislabeled the triangle or you were a little bit too early and you jumped the gun slightly, all right? But as you can see from these screenshots, once we get that break past the wave D extreme, I'm expecting a swift thrust out of the triangle. Here we have one in the Swiss franc Japanese yen currency pair. Again, very swift takeoff once we break the wave D extreme. And the wave E stop loss tends to be quite tight, giving us excellent risk-reward parameters for this trade. Here we have one in a cryptocurrency called Mina. Again, wave D, break of the wave D extreme, stop just beyond the wave E extreme, and we get a very swift fall out of the triangle. There have been periods of time where I'd go weeks, if not entire months, only trading triangles because the pattern is so reliable. If I could only pick one pattern to trade for the rest of my life, it would probably be the triangle. And here's another one in the Aussie Canadian dollar currency pair. All right, we're looking for a break of that wave D extreme. And again, here we get a fairly swift resolution. The reason I'm including this example is because the market is not always going to follow a textbook path. Here we did get a fierce thrust out, and then we pulled back to that wave D level, retesting it as valid resistance before getting that resolution to the triangle thrust. This is more unusual, all right? What I'd expect most of the time is something like this in Netflix, where once we break that wave D extreme, we don't really look back. We just keep thrusting out of the triangle. But it's important to bear in mind, not every triangle is going to resolve the exact same way. Okay, so the final example I have here for you is this contracting triangle in Tesla, right? So we break that wave D extreme, market shoots off shortly thereafter, and we get a phenomenal resolution to this triangle. All right, so that's it, folks. Triangles are pretty straightforward. I really don't have to harp on this corrective pattern for too much. I love the fact that a lot of you guys have been sending me some charts with corrective patterns that you either looking to trade, have questions about, or in many cases actually have successfully traded. That makes me so happy. That means that what I'm doing here actually means something. I'm showing you something actionable that you can start testing and then potentially implementing right away into your trading plan if it suits you. Okay, so that's it for me, guys. I will see you next week. We're going to cover trading one more pattern, which are diagonals, which might be my second favorite pattern to trade after the triangle. And then we're going to move into some other exciting stuff. Not as exciting as entry points and stop losses on specific chart patterns, but equally important. We're going to talk about Fibonacci relationships in the market. So that's it for me, folks. We're going to keep this one nice and short and sweet, and I will see you soon. Take care, everyone.